Welcome to your closing markets. I'm Michelle Rook, joined with Mike Zuzolo with Global Commodity Analytics. Well, we're closing kind of mixed over in the grain trade, livestock, kind of mixed in hogs, but a little bit higher in the cattle sector today. And Mike, let's talk about the grain trade. We started off with a little strength in corn and soybeans this morning. It looked like maybe we were trading the exports, which were a little bit better this morning, at least to start off with.
Yeah, I think that's exactly right. Spread unwinding is kind of what I would make the hallmark of the trade before this quarterly grain stocks report, Michelle, is traders were probably going after the recovering of the short corn and bean positions and liquidating out of the wheat market. The wheat market continues to drive this train. In fact, for the month of September, soft red wheat is approaching almost 90 cents in terms of gains from where it closed on August 31st. So that's a pretty hefty gain for the month in the wheat market, but trading suspected probably to be more of a mindset of short-term position squaring before we get those quarterly stocks numbers, and with the outside market still directing us very, very strongly. While we had a weaker dollar, we also had weaker natural gas and weaker crude oil, and it seemed like the wheat market had a lot more footing and buying potential and market underneath us more if we had the energy strong, but did not have that today. And so I think that added to the reason why the wheat market wanted to go ahead and liquidate some positions.
Right. And the wheat market, like you say, we've got up into levels where maybe we've seen a little profit taking and consolidation. Does that market also need some fresh news from the Russia-Ukraine front to keep going here or not?
I think it does, in a sense that the commitment of traders report all month has shown the funds out of position when it comes to corn, beans, and wheat. They've been too long corn, especially too long beans, and too short wheat. I think the month of September, when you look at the decline of almost 90 cents in the soybean complex at this point, 96 cents as of Thursday's close with November beans. I think getting back to where the commitment of traders report has done what it needs to do. The funds and the managed money positions have done what they need to do based upon the fundamentals. Having said that, I still think we've got a lot of drought problems in Argentina that aren't getting better. Our drought monitor for Kansas, Nebraska, Oklahoma did not improve. It actually got worse. In fact, Kansas looks more like Oklahoma in terms of drought, and that's not a good thing because we're showing a lot of deep red drought that's not going to go away unless we have a major change in the climate here in the next 10 to 15 days. And I've still got clients reporting this week. They're just dusting in wheat, praying for a rain. Otherwise, it's just simply not going to come up.
So you're saying that we need new news either on the crop production side of things or geopolitically to keep this wheat market supported, or what?
Yeah, what I'm saying, that's a great follow-up question. What I'm saying is, especially with the stocks report right in front of us, is that if we want to make new highs, if I'm correct and we're roughly 80 cents too cheap still in the wheat market, we probably need either the Ukraine-Russia story to feel some heat again and the market to shift its attention back to that, or a good stocks report tomorrow. Otherwise, I think we're very well underpinned in the wheat, but that doesn't mean we go to new highs.
So talk about quarterly stocks, because tomorrow the average trade guesses for wheat and beans are pretty close to where we were last year at this time. Corn, not so much, over 1.5 billion bushels, which is bigger than a year ago. But what are you looking for? What should we be looking for there in those numbers?
I'd like to see less stocks of soybeans. I think the trade is mentally prepared for that, mentally thinking that's going to happen. And if we don't see that, I think that will be a negative feature and reaction in the marketplace. For the corn, it's how much more than last year, I think, is the trade sentiment right now, because rightfully so, the trade has seen a pullback in ethanol consumption, production as a result of that. And also these exports just don't seem to really want to get kicked into a higher gear. So I feel like, we're probably around a mindset of about 225 million bushels more than September 1 of 2021. I wouldn't want it to go more than 250 million more. Otherwise, I think the trade will feel like we have excess inventories. And I say that especially, Michelle, on both the corn and beans, because I continue to hear, even though it's still early on, I continue to hear really surprisingly good yields from the producers, that they are surprised at how well their corn and beans have held up even in the droughty areas. And so any added stocks, any additional supplies from the stocks report, I think adds a little bit more weight to the market because we're putting new supplies on the market as well.
So what doesn't, I guess, jive for me with the quarterly stocks for corn is what we're seeing in terms of cash basis levels. You look at some areas of Kansas where you're at, and corn is sometimes $2 over the board. So that doesn't jive with the quarterly stocks to me, or is it just kind of some regional things that we're seeing?
I think it's regional, but I also feel like that you have a very valid point. We used to get those weekly corn stocks reports that the commercials would have to put out as either every Monday or Tuesday morning. And I miss those. I think we lost those about 7 or 8 years ago, but those really kept us on the ball with what we had in terms of commercial inventories. I will say I've been surprised at the number of clients and producers that have called over the last 3 or 4 weeks, ever since the last high was put in, having more 2021 corn, especially, but even extra 2021 beans than I thought they had. So I think maybe we've got a little bit more on farm out there. And that's the breakdown that's important this time of the year. If it's commercial owned stocks, that's probably going to be more bearish to the market, because then your basis will probably widen even more and weaken even more because of less room at the commercial facilities.
So you and I can sit here and talk about fundamentals all we want, but really, when you look at the macroeconomic climate, what's been happening with new highs in the dollar, we have been caught up in all of that. At what point do you think we divorce ourselves from that, and how long will this risk off last, do you think, in the outsides?
I don't think we'll ever divorce ourselves at this point because of the Federal Reserve policy, Michelle. I think the Federal Reserve has essentially said, look, we want less demand, and by hook or by crook, and meaning we're going to tighten until you feel it. And the equities markets and some of the commodities markets, like livestock, have started to feel it a lot more since the
Right.
Federal Reserve last spoke. But my basic point is this, is they are looking at cutting demand. Our major problem with inflation is cost. It's supply side. And so they are just by definition wanting to offset with lower demand what we have in supply side inflation. And I think that's going to stick with us for the next, 6 to 8 months. I think we're going to be driven higher by supply side, weather side type fundamentals, whereas the Federal Reserve and the central banks. And I think a global recession is something we need to be talking about with our clients and with our subscribers at this point for 2023.
Well, obviously, the fund managers have gotten out of some of their positions in the cattle market because of what you just said. They're concerned about that. And so, at what point do you see us finding a stabilization here in the cattle market, or are the funds going to continue to liquidate and press that market technically?
Yeah, I mean, they could continue to liquidate, but I don't think if I were them, I don't think I would right now, because we're just a couple dollars away from a major support line in the hog complex. The Chinese are releasing, I think for a third time in a month, some more pork reserves at the end of this week to cool their domestic prices. And we've had a terrific fall in the feeder complex. And if the corn turns negative, then the feeders should be able to find some support off that. So I think if I were a fund right now, if I've lightened up some, I'd be in a wait and see attitude, especially with the cash prices late this week coming through in Nebraska at that 130, 144 level. Kind of tells you that we're in the right ballpark where we're trading the October fats right now.
Yeah, steady to better cash trade, obviously, in the north, and the market kind of faded it, unfortunately. But let's talk about hogs as well here. So the market has had a lot of fund liquidation there too. We've done some pretty significant chart damage. And do you think that we're getting close to a bottom there?
I really do. I think the cutout value should be able to stabilize, because we really do have way too high of beef and poultry prices still, even though we're going into a weaker seasonal until we get to the ham seasonal for Christmas, and we've got the turkey seasonal coming up for Thanksgiving. I feel like we've done enough damage from a pure consumer supply demand, what the consumer's paying in the price. I'll give you an example. In Tokyo this week, McDonald's raised their price in a hamburger in Tokyo, Japan for a second time since March. It's now up 40% from where it was back in March. That's too much, too fast. And I think it's going to make the concentration of demand, the consumer, go out there and find a substitute. So I'm also watching the hurricane. Right now it's only supposed to go into Georgia, which is not a massive hog state, more of a poultry state, but southeastern North Carolina is a very high concentration of a lot of pigs, several million pigs. And if that would reform into a substantial hurricane and go into North Carolina, I think that would affect our hog supplies.
Yeah, and the hog market is not really trading it at all, is it?
No, I don't think so. I think it's got its eyes all fixed on the other complexes and also what we're going to look at for the hogs and pigs report.
Yeah, and of course, that's going to come out after you and I get done talking there. But what are you going to be watching in the report?
To me, it's all about kept for breeding, because that's the thing that the cattle and the hogs both have going for them, as a less supply in the hogs. We've turned the corner now. We've made that peak in supply. So kept for breeding, the market's expecting just below 100%. I wouldn't want it to go above 100%, because then all of a sudden we've got the signal that the market price has signaled to the breeders and the farrowers to go after more production, and that could start to work against us as we get into 2023.
Gotcha. Some good discussion today. Thanks so much, Mike Zuzolo with Global Commodity Analytics.